The most important part of an investment isn't how exciting it looks today, it's whether that money is still compounding for you 20 years from now. With one S&P 500 index fund, you buy a slice of the 500 largest publicly traded US companies all at once. That means Apple, Microsoft, Amazon, Berkshire Hathaway, and hundreds more are all sitting in the same basket. And over time, weaker companies are removed and replaced, so the fund keeps following the market's long climb instead of betting everything on one stock. Historically, the S&P 500 has returned about 10% a year on average when you zoom out across multiple decades. At that rate, your money doesn't just grow a little. In 20 years, it becomes tens of thousands. That's the point. The heavy lifting comes from time and compounding, not from guessing which stock will be the next big winner. And to be fair, the dream is real. Nvidia and Tesla are the kind of stocks that can leave the market in the dust and make one great pick look life-changing. But when researchers track the pros over 15 years, roughly 90% of active managers still fail to beat the S&P 500. If people doing this full-time usually can't win that game, your weekend stock picks are fighting even steeper odds. Professional managers have analyst teams, deep research budgets, and institutional-grade tools. Even with all that firepower, most still finish behind a simple index fund. A manager can look brilliant for a year or two. The hard part is doing it again and again over 10, 15, or 20 years. And stock picking asks for two hard calls twice. You have to know what to buy and when to buy it, then know when to sell and where to go next. When your portfolio leans on just a handful of stocks, one ugly earnings report, a new regulation, or a product flop can hit your whole account at once. Cut in half is brutal. A 50% drop needs a 100% gain just to get you back where you started. And the hole gets steeper fast. The more you lose, the more recovery stops being a climb and starts feeling like a wall. When a portfolio drops hard, a lot of ordinary investors don't just feel nervous. They panic, hit sell, and bail out right near the bottom. That sale turns a temporary drop into a permanent loss, and money that could have recovered over years of compounding never gets the chance. Broad index diversification makes this easier. You can stay invested through the turbulence instead of making a new emotional decision every time a scary headline lands. The better question isn't index funds or stocks forever. It's how much risk you want sitting in each bucket. A blended approach still gives you a shot at extra growth without letting one pick become the single hinge for your whole plan. That's the real target. Keep your core protected and leave a smaller lane open for upside. A simple way to do it is to put about 80 to 90% into low-cost, broad market index funds like VU or VTI. Then use the remaining 10 to 20% for individual stocks you actually want to study, track, and understand over time. That way, even if your explore picks miss, the core is still doing the real job of carrying your long-term plan forward. Broad index exposure keeps your money tied to the market's overall engine instead of letting one company's bad quarter decide your future. Low-cost funds help in a quieter way. They take less off the top, so more of each year's gain stays in the account and keeps building on itself. And when your stock picks run hot one year and cold the next, that core keeps compounding in the background, which is exactly what holds the whole plan together. When your thesis is right, one stock really can outrun the market and deliver a gain that feels impossible to ignore. That's why a smaller explore sleeve works so well. You keep that upside alive without letting one idea take over the whole account. So if an explore pick hits, it feels exciting and worth it. And if it doesn't, your entire portfolio still sleeps just fine. In practice, the index fund is still doing the real work. It's the piece carrying retirement and building long-term wealth year after year. That leaves your stock picking sleeve free to do something different. It's where you back your strongest ideas, learn by following real companies, and experiment without putting the whole plan at risk. And this is where discipline matters. When one stock can jump or drop fast, position size protects you more reliably than confidence ever will. A diversified core keeps one bad call from turning into lasting damage, because no single mistake gets to rewrite your whole future. Your concentrated bets can still have a place, but they belong in the upside bucket, not under the part of your plan that's supposed to carry retirement. The best portfolio isn't the one that looks smartest in a rally. It's the one you can keep holding when prices surge and when they break. Wealth usually isn't built by finding the next lottery ticket. It's built by doing the same sensible thing over and over, even when that feels less exciting. Compounding pays you for staying in the game. It does that far more reliably than trying to predict which stock will explode next. And that boring path often wins for one simple reason. It's easier to stick with year after year when headlines get loud and emotions get expensive. When you judge the full game instead of one flashy winner, index funds come out ahead on breadth, resilience, and the odds of actually working over time. Individual stocks can absolutely win, but usually only when the pick is unusually sharp and the timing is unusually right, which is a much narrower path. So over a long investing life, the smarter bet is to own the market first, then speculate with a smaller slice second. If what you want most is a plan that feels simple, diversified, and easier to live with, this is exactly who index funds are built for. They're especially powerful for beginners and long-term savers because they take the constant guessing out of what to buy next. And if you don't want to spend your evenings tracking earnings calls, product launches, and management drama, the index fund should be the center of the portfolio. If you genuinely like digging into companies and you can handle the ups and downs, a small explore sleeve can make sense. What matters is the size. Keep it small enough that one bad pick can't blow a hole in the plan you've spent years building. That's where conviction belongs, in the margin, not in the whole portfolio. So if you're making the $10,000 choice today, make the market your foundation and let stock picking stay the side bets. Start with the core, then add the extra only if you want it.